Welcome to the Dividend Talk podcast, episode 206. Earnings insights from several iconic dividend stocks. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit europeandgi.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DJ. It feels like forever since we recorded a show. How was your vacation? How are you?
Well, it's been forever because it was about 3 weeks ago, Derek. I'm doing really well. I was on vacation to sunny Croatia. I really enjoyed it there. Great sun, great atmosphere, great time. Definitely also nice time spending there with the kids and the other half, of course. Thinking a little bit about investing as well, but not too much. It was, by the way, fun in the morning on the campsite with your own instant coffee to quickly browse some reports and see if your holdings are doing well. And I must say, remarkably, most of my holdings have been doing really well this earnings season. So they may be the most boring businesses in the world, but they just continue to deliver. And we'll speak about a few this show as well, but I'm very much surprised. So I'm not in this a lot in these growth stories, high growth stories that are priced for perfection. So I'm not feeling the pain of minus 10 here and there everywhere, if it is this very small part of the position. But of course, we will talk soon also a little bit in news of the week about one of them. That's the only one where it was a bit of a bummer. But for the rest, it just does really well. And I don't know about you, but it's really nice to see that it's not just dividend stability, but also earning stability for my holdings. And that's, I think, what people don't often realize, that it's not just. I mean, it's kind of a cause and effect, or what is first? Stable dividends and therefore stable earnings, or stable earnings and therefore stable dividends? I think they work in yin and yang together. I think that dividends put pressure on management to focus on the long term as well. Specifically those companies that are really focused with their policies on a progressive dividend policy over time. I think it triggers a more long-term mindset in management as well. Because management knows, for instance, I don't know, in certain companies, you hear even CFOs or CEOs saying this, right? Okay, we need to make sure we have the dividend, that we can afford the dividend and can continue growing it, right? So if you start thinking around that, you do also know that on the earnings side, that where it needs to come from. Yeah. But of course, it will be stupid to manage the company just purely from the dividend. The dividend is a profit sharing. And some other companies will say, and we speak about one of them as well today, Texas Instruments, like, hey, we are investing now for the future. Yeah. So, but I think there is some yin yang going on there. There is some relationship there. I think that people are not often aware of even.
Yeah, I would agree definitely in terms of an American perspective, because we know they put so much pressure on their dividend history, their aristocrat status, and they're kind of proud to pay those dividends, and it's almost part of their investment case and trying to get us retailers in. European companies are a little bit more, we'll pay from our earnings.
On average, but there are some European companies that think differently, right?
Yeah,
like even British American Tobacco. Yeah,
Yeah, the ones that try to be American, in my point of view, and maybe Shell is part of that group. They
yeah,
report in US dollars, so it almost
yeah,
has a more American feel to it. But
yeah.
yeah,
True.
it's an interesting take. But yeah, there's been so much after happening in the last 3 weeks. But we'll try and focus on what happened recently, so we're not going too far back into the past. But before
But
we start
yeah,
all of this, we get into the news of the week. We'll get into that, but we haven't been very active on social media. Well, definitely I haven't over the last 3 weeks. I was on vacation, then I was on 2 work trips, and it just meant that I didn't have the time. So I know our Facebook is getting littered with spam when we're not there, and our moderators are doing such a good job. I went on today for the first time in about a week, and there were 7 requests already there. So I can only imagine what has come through. So I just want to say huge thanks to the guys. We've got four people looking after it. Alexis, Tim, Jeremy, and Matthias, and they do a great job.
yeah. Thanks. And it's also, I said, nice to see because our Facebook group is just very active at the moment. So maybe that's also why it's attractive for spammers. So yeah, thanks to our moderators to try to keep it as clean as possible. And we may need to make it a bit more stricter here and there. I was chatting with Alex about it, but I think we're good for now. Still, it's still manageable, but otherwise we need to, because we want to keep the entry barrier for new
Yeah, of course.
members really low. We don't want to make an exclusive group. This dividend talk is for everyone. It comes with the Facebook group attached to it, where we can further talk about dividends after the show and such. And people are helping each other out today or this week. Someone's asking about, hey, how do we do dividend taxation in Germany, as an example? So we want to keep it like that. So, hey, and if people are not there yet, please join us. We'll have the link in the show notes. But yeah, thanks to our moderators for keeping it clean.
Yeah, of course. Okay, on to the news of the weekend. It's a pretty big week. Those of you who have been laser focused will have noticed that Intel is struggling. It's cutting 15% of its workforce, and on top of that, it is getting rid or suspending the dividend. Wow, wow, wow. I did not see that coming. What do you think?
Well, I'm not surprised. After the initial dividend cut, I was even surprised that they kept the dividend. I thought, like, why are you keeping the dividend if you're investing so much?
Yeah,
They need every penny at the moment, and this dividend over the last few quarters was just a waste of money. Truly, I think investors they lost the dividend investors with the first cut, so they could have cut it just to zero and straight away do a full kitchen sink at that time. Now they need to cut it again. I mean, I don't think anyone is worrying about this or anyone lies away from this. So they just lost a few billion again in this process, which could have been invested in the factories that they are building. So I mean, I think the sentiment right now is with people that invested in Intel for the turnaround story. I think they are losing their patience. And it's not so much about, I said, Intel doing stuff. They do a lot, but their new products that are coming out, they seem to be already like not
yeah,
adding a lot of value, right? When they hit the market. So
yeah,
the Pat Gelsinger, I think, entered the company that was more broken than everyone could have ever imagined, how badly broken it was. And it is a long investment cycle. So on the other hand, I mean, still these new machines are coming online at a certain moment, right? But if you can't get the designs right, yeah, so a lot of people are losing their patience here. And we had one question here as well from Salim Shamas, who asked for our thoughts about Intel. So I know you don't own them, so I'm curious about your thoughts here.
No, and I'm so glad I don't own them now. If I'm honest, so I was like you. I think we spoke about it when they cut the dividend initially.
Yeah,
I I hate this management lingo, competitive dividend. Okay,
yeah,
and they're just trying to package it up in a way where everything seems okay, but fundamentally they were struggling. They're losing
yeah,
market share. Nvidia, Qualcomm, they all seem to be taking Intel's lunch at the moment.
yeah.
And it's just hard to see how they're going to claw that back in the short term. It's probably a long-term project, but the question is for investors, how long do you want to wait?
Yeah.
And personally, I don't think they're investable for me in that in this moment. I just think there's better competitors that are doing better things that are so far ahead of them.
Yeah.
I think Intel have to be in deep value. They're still trading at a decent price level. I think are they $29 or $30? I can't remember.
No, they dropped by 20 or 30% after the announcement.
Oh,
So
I'm not surprised.
yeah,
But yeah, I think when you because you can directly compare them to the likes of Nvidia, who are doing so much better.
yeah,
It's hard to see how they navigate this. And Pat Gelsinger has said a lot of the right things, but
yeah,
his execution clearly has not matched what he has said.
yeah. So maybe full disclosure, the stock trades now $21.50. It
Oh,
dropped on Friday 26%.
wow.
So another quarter of its value. So hey, everyone knows, I think, I still own a few. It's always been by design a very small position. The question is, will I still take my money out and redeploy it elsewhere? I wanna have a bit of a deeper thoughts about that. But maybe I just need to sell it. I don't care if it's selling at the bottom or not. I can still get the money elsewhere. But there's always been turnaround play for me, and I always had 2025 on the horizon in my mind
Yeah.
with these new machines from ASML coming online. So I need to think a bit deeper and see if I can find any information about that. What's the progress on that? Because I haven't been able to digest the numbers here.
Yeah, but just to challenge you a little bit on this, it's not a dividend company, that's clear.
Yeah.
It's
It's also not in my
it's
dividend portfolio.
okay, but it's not a growth company either. So what
No,
is
it's one of my last turnarounds that I
yeah,
invested in.
yeah,
And then we discussed that multiple times on the podcast here. I've got this few percent that I invest in growth or turnarounds. I've been bitten too often by turnarounds that I stopped doing that really. The only one I still did was Meta, and I more than doubled my money there. I bought at 170 on average and sold at 500. But I would call that more luck than wisdom. Yeah, and maybe that's the same case here, but then just towards the other side.
yeah. Yeah, I'm interested to hear from some of our other listeners. I know quite a few still own Intel or have owned Intel and have
Yeah.
held them for a turnaround.
On Facebook, there was a conversation going on, and I would say half of them lost their patience, and the other half thinks it's an opportunity.
Yeah, yeah. And hey, look,
It shows the stock market.
it does.
Yeah.
And those that still have patience, God bless you, because you have a hell of a lot of patience. Yeah, I'm glad I got out when I did, because yeah, turnarounds are just stressful. I don't know.
Yeah. So for me, I still sleep well at night. It's such a small position, and it even got smaller now. So
Yeah, yeah. But speaking of which, I know Intel, look, it wasn't the best news in the world. But do you think part of their share price was a lot to do with this market starting to cool down? I believe
yeah,
over.
because chip stocks also got hammered on
Yeah,
Friday. So yesterday, I think ASML 11% down. So I think, yeah, that there was probably a double whammy. Let's call it like that. Yeah, I don't know where it came from. Suddenly Friday, everyone starts to worry about recessions. I mean, we are reading already many reports already since the first quarter about a weaker consumer. So I don't know why it should suddenly change on a Friday. Yeah, on a Friday like this, and that everyone thinks like, oh, what the hell? Let's put my whole portfolio down 2% by selling everything here. I don't understand this. Like where this sudden awakeness comes from. Yeah, also that the Fed may only do one rate cut here, so maybe that started to land in people's brains. But I think like I don't get the market with these kinds of things,
no,
right? And then I see red, I see here 10% down, 11%. I look at some of my holdings, 3% down, 4% down, and I feel like, well, I hope this lasts for another few days at this tempo, because then I will be buying the same stocks that I was willing to buy today at a 20% discount or something like that. Probably it
yeah,
won't work like that, but that's the only thing I'm thinking. But I don't understand the market. I really don't understand it like this.
yeah. It was quite crazy. But the only thing is, my portfolio in the 3 or 4 weeks leading up to that, since the last time we spoke,
Yeah,
it has really been on fire. I mean, it's
mine as well.
British American Tobacco popped, some of the real estate popped, Greggs has popped, CRH has popped, Blackstone is doing really well. I don't know why. So I think even with Friday, like, it's still up massively over the last 3 weeks. So it was no concern, but it was just funny. Kind of, I tuned into Twitter and there was like panic, and I was like kind of singing in my own little bubble, going, I don't really see the problem. I don't know what's going on.
My overall portfolio is still about 4 or 5% up since the end of Q2 when we did our earnings quarterly report. So it's still, let's say 4% approximately. It's up. I mean, what are we talking about?
Exactly. Yeah. It's crazy. And all this on the worries that a recession might be coming. And we've been saying that now for the last 24 months.
Yeah, but they also say there's a big rotation going on from high value tech stocks into more value stocks, and we naturally are more in that spectrum there with our dividend growth holdings. So maybe that's also why. But like I entered, like we started the podcast, for me mostly it's based on good earnings. Yeah, just the earnings are popping up my portfolio, and that's the best you can have, because it's fundamental growth, not expectation as such only. Yeah. Anyway, I think people that listen more often to us, like these days, are for us rather opportunities. But if you zoom out, then you see we're still at the peak of all-time highs on most of the stock markets worldwide. So yeah, opportunities everywhere.
And then we had one other piece of news, and I think that this is from our good friend Russ. He must have highlighted this. But Agree Realty, who we both have and both are bullish on, I believe, they received an upgrade to BBB Plus from S&P Global Ratings. The highlights of that is obviously their highly occupied portfolio, and obviously they've got a really high investment grade tenant base. So good news for them.
Yeah, definitely. And there are only a few A-rated
real estate
investment trusts, like 7 or so, and this is one level below an A rating, so they're really close to it. I believe Realty Income has an A rating, so they're really close to it. And I wouldn't be surprised if in the next few years we see another upgrade, because the quality is there already. I don't know why the credit rating just don't give it straight away an A rating.
Yeah,
of course it is just in the business of real estate investment trust, but I don't understand why Agree Realty should have a lower rating than Realty Income. That's what I don't understand. Maybe the downgrade for Realty Income is just should happen then to make it BB plus.
Yeah, I think it's just a size difference, isn't it? It's just the market cap size between both of them has to play into it somehow. But in terms of, if you look at the quality of your portfolio, you would argue that it should be reversed.
Yeah, exactly.
Perfect. So back to dividend announcements, and there's been quite a few since the last time we recorded, thankfully. We went through a period where we didn't have too many, but we'll start naming out a few big ones here. First one, Unilever. I'm surprised at this. Hikes the dividend by 3% after
for the first time in 4 years since 2020, under the management of Ellen Yopi.
Yeah. So 3%. Look, it's not going to make you rich, but it's better than being flat for the last 4 years. Greggs Plc hikes their interim dividend by nearly 19%. That's a massive hike from Greggs. BP hiked the dividend by 10%. The London Stock Exchange Group hikes their dividend by nearly 15% to 41 pence per share. BAE Systems hiked the dividend by 8%. Relics hiked their dividend by 17%. We have a lot of big hikes, don't we?
7%. 7%.
Up from 17p. Sorry, I read that wrong. Wolters Kluwer had a 15% dividend hike. For such a boring company, they just keep doing double digit.
This one is a bit tricky, actually, because they have, what I understood, more like a dividend policy to pay the interim dividend as 40% of the final of the total dividend from last year. So it's actually kind of an embedded hike from last year. implicitly in there. But yeah, still, it's a lot.
Clever. Record Benkinsur hikes the half-year dividend by 5%. LVMH kept their dividend flat. Are you surprised at that one?
Yine.
Yeah, Illinois Toolworks raised the dividend by 7.1%. Dover had their 69th consecutive dividend hike, and it was increased by nearly 1%. Iron Mountain increased by 10%. America States Water, I believe that's 70 years or above, is it? They've hiked their dividend, but they had a big hike of 8.3. Two more to go. Mondelez International 10%, and the Clorox Company with a paltry 1.7%. But man, that's a serious list.
Yeah. It's earnings dividend hike season, right? So a lot of British companies have the half-year reports and announce the interim dividends based on that as well. So a really good time to be in. Those British dividends, we love them because they come at the initial 0 dividend tax. So yeah, hey, I'm surprised by Greggs 18.8. I never heard of this stock until you started analyzing it, writing about it and such. So congrats on that one. Also, congrats on, by the way, British American Tobacco. You mentioned that earlier a little bit.
Yeah.
You're doing well with those holdings, I would say.
Yeah, and BAE was one I was looking at. I think they were, I expected them to do well, because of the moment in time that we were in. And there's lots of defense systems, but they just seem a little bit richly valued. But 8% is still a good hike for these guys.
Nice.
Nice.
So let's start with the main topic then, because dividend hikes, they only come usually on the back of strong earnings. And, my largest position is Shell. But instead of me talking about it, I would love you to talk about Shell and share your view. Is it also your largest holding?
It is my, it's top 3 anyway, definitely top 3.
Okay.
They've been hovering top 3, but I think Agree Realty might have taken them over. But yeah, it's definitely top 3. When I look at Shell and I look at the numbers they produce, it's like I said to you, I'm going to Vegas next week on vacation, and Shell is like that. It's like sitting at a slot machine and they just keep giving you money back. On the top, at the very top of their very first slide, they mentioned that they are doing another 3.5 billion buyback program for the next 3 months. Yes, you heard that, 3.5 billion for the next 3 months. Okay. And that's on top of the 13.5 that they've executed over the last 12 months. I know you did a tweet, or you did some analysis on that, how much of the business they've actually bought back over the last couple of years, but it's been phenomenal, the amount.
Yeah, and in the last year, just one single year, they repurchased 6.4% of their shares outstanding. So all of us who were holding, our equity grew by 6.4%. Well, actually more, but if you would only look at the impact of the buybacks, that's a lot. Yeah, if you look at many people that think about 7% plus a dividend of 3% is like 10%. So if you need to look at it. Of course, it's an oil and gas company, so it's cyclical. You can't just think like, oh, every year 7% more earnings, but just the buybacks, it's amazing.
The buybacks alone are incredible,
and it's out of cash flow, right? So the buybacks and the dividends are all covered by the cash flow.
Yeah. You look at their operating cash flow, funds from operations. I think it's about 13.5 billion. Free cash flow stands at 10.2. Their dividends in the quarter are 6.1 billion. And then even with the 3.5 billion every quarter that they're spending, they still have cash flow left over, and they use that little bit of cash flow to pay down some of their debt as well.
Yes, because debt went also to 38 billion. And because last time it was hovering around 40, 44.
Yeah.
Nice to see it down. I sometimes I was thinking this week, why don't they just go like to AAA balance sheet with this? Yeah, I know there's this math you can do like about shareholder returns, and there's an optimum playing with the debt level. That's why they have all this gearing and there as a metric. They thought like, why don't just pay another 20 billion down in the upcoming 2 years, and you will have a huge war chest after that as well for doing a major acquisition. And secondly, after that you can do even more. And when when there will be an oil crisis again, you don't need to worry so much. So I feel like they could even do better with the debt pay
Yeah,
down.
and they showed that, didn't they? When after they've cut the dividend and we started getting into this cash flow rich stage that they're in, I think their debt was around 54, 55, and they needed to bring it down
Yeah,
closer to the 40 billion to
yeah.
maintain their
And they were
credit
there
rating.
in no time. Yeah,
And they just ripped through that. But yeah, it's a tough one. Would you rather than pay down the debt or continue to buy back
pay down the
shares?
debt.
Yeah.
Um,
Is that because the shares are at all-time highs?
no, because of the financial flexibility it will give the company.
Mm.
Yeah, because what they had to do last time is they had to issue dividends to pay a scrip dividend, issue shares to pay a scrip dividend. So at that moment, the shares were at a 10% yield or something like that, and people were opting for that. Yeah.
Yeah.
So at that moment in time, they're increasing the share count again. So rather avoid that you're not selling your shares at a 15 euros per share or something like that. Just then put it totally out of the cash reserves by increasing the debt a little bit.
Yeah. Yeah, but they've got so much cash. I mean, it's hard to see him buying back shares for forever. There'll be nothing
Yeah.
left if they keep going the way it is. So
No, but
eventually,
that's good. That's
yeah,
good. Let them buy back if they can buy back. I mean, the oil has been trading between 80 and 95 now for 1.5 years.
yeah,
And I read an article this week where they were saying like, is oil losing the mojo? It's just trading in it's not breaking out. I think like this is perfect. The moment it goes above $100, all the news stations are talking about it. People get fed up with it, and they start blaming Shell again for being not a good corporate citizen. Let's say it like that here. So I think between 80 and 95, it's kind of nobody's complaining. It's generating loads of cash. You don't create. I think it's an optimum because if you also go above 100, people are more likely to say we need renewable energy more, and I want my electric car. Like that. In this range, it's relatively peaceful,
yeah,
quiet, smooth
yeah,
sailing. 6% buyback yield, 3.3% dividend yield. That's a return of almost 10%. Let it be.
yeah.
Yeah.
Just sit back and relax. But in terms of how they performed financially or in terms of their revenue numbers, it's been pretty much flat compared to this time last year. The numbers are
Yeah.
like a couple of 0.2% in the difference. Quarter over quarter, it's down slightly over the first quarter because there was some pricing and volume pressures on the integrated gas. And we know gas went through the roof with inflation, but prices seem to be normalizing. So, but there's nothing really to be concerned about. They are just keep spitting out those. One thing I did notice though is their renewable energy, which had negative earnings this time, that has gone nowhere in the last 12 months. So they're not, I think they're just letting that to sit there and die. And we know the CEO came out and pretty much said that they are pivoting away from that. They put greater emphasis on it before, and now it's just dwindling away. So it's just sitting there, kind of whatever they have now seems to be. They just let it sit there and see how that plays out. But yeah, it's for me. It was typical Shell over the last, I would say, 24 months. It's been exactly the same. More dividend announcements, more buyback announcements, and a shit ton of cash to deploy. So how can you not like that?
Yeah. No, for me, I mean, and that's also the question. Shell is now trading at 34 euros approximately. Every time that it came to this level, to an all-time high, the stock market crashed after that. So maybe it's going to do this again. But my question to you is like, do you find 34 euros for someone who has been looking at oil and gas stocks at Shell, wants to invest in Shell already for 1-2 years, just sees the price doing well, a share price doing well and everything? Do you think that today is still a good time to initiate, for instance, a position in Shell?
I think so. I think so as well. If you look at how much cash flow they're generating, what they're returning to you as an investor, you already mentioned it: 3% dividend yield, 6% buyback yield. You're getting almost 10% in returns. Ignoring the share price because you know it can crash, and there's outside factors that affect oil, and we all know we can't control that. But yeah, I see no reason to it. Now, I would not go 100% all in with my full position on them because oil is so cyclical. I'd much rather be buying them at the bottom of a cycle. Whether they're at the top of a cycle, I don't know, but they're definitely not at the bottom. But I think as an investment and a return on investment, you're still getting good returns from them. So I'd have no hesitation. The only other thing is we spoke about it. They're flirting with moving onto the US exchanges as well, and if they do that, we could see their share price almost double as well, which would be a good time. But yeah, no, I think they're reasonably. I wouldn't say they're undervalued. I would say they're reasonably valued at these prices.
Yeah, I would also just take the dividend discount model here. They predict a 4%. That's a dividend policy, 4% dividend growth for the many next years. Just plug it in and see what it does for you.
Yeah, and the share buybacks on top of it. I mean, they're reducing that share count. So come on, it's a.
So I hope we also answered Maurice's question here. He had a question about our thoughts on the share buyback program and such. So yeah, great story. It continues, and I'm a happy the peppy shareholder here.
Yeah, it's almost getting boring. You know, when we talk about some companies and we talk about clockwork, it's almost like that because the last 24 months, it's nearly been the same. But we do know oil and gas can change quite quickly. So
yeah,
let's not rest on our laurels. Let's enjoy it while we have it.
Yeah. Okay, then let me go to the second company then. And I have to talk about an Italian company because the other time we got feedback, we don't talk so much about Italian companies, but let's be then also taking the best of the best. And that's Ferrari with ticker symbol RACE, RACE. You know, the first thing I had to look at is not about the revenue numbers, but what are they actually selling? And they sold 17 more cars in Europe and the Middle East. But in total, Americas has been on fire. They sold 112 more cars in the Americas. And interestingly, 61 cars less in China, Hong Kong, and Taiwan. So mostly China, right? So overall, in the last quarter, they sold 92 more cars, 3% more because they sold about 3,484 cars or shipments. That's what we need to say, which is very interesting because, you know, if there's one consumer that is weak that we have seen when it comes to luxury products, it's the Chinese one. Yeah, we've seen it with Starbucks. We've seen it with Nike. We see it now with Ferrari. We've seen it with LVMH. Where we haven't seen it is Hermes and L'Oreal. They seem to still escape from it. Of course, there's also a bit of a sentiment towards European companies or international companies in China, but generally the consumer seems to be really weak there. Go opening up a few earnings reports and you see it everywhere. So that is very interesting, and you know, just knowing that they only produce like 3,500 of those cars really keeps this exclusivity, right? And there's a lot of personalization going on in those cars, and that comes, of course, with really premium pricing. So Ferrari is really doing well. What is also interesting for me is that 48% of their shipments in the last quarter were hybrid cars. Yeah, which is also very interesting, right? They really made a proper shift. I think it was Ferrari that was also talking about going electric, but then that they still had to figure out how they could replicate the noise of the engine without faking the noise, like via a software program or something like that.
Yeah.
So I think they really, really understand where their value and the experience that customers have comes from, and that is this sound when you start the engine, right? It is that you stand in front of the traffic light and everyone is watching at you. So I think a very smart CEO. Maybe a bit then to the financials. So revenues are up 16%. So I just mentioned that 3% more shipments, but 16% more revenue. It means that they have a really strong pricing power by really keeping a Ferrari kind of a luxury symbol, but also in scarcity. Yeah, they could probably scale up much faster if they wanted to, by lowering the price or something like that. But then we all know it will come commodity, it will lose its shine, and people don't want it anymore. Well, this led them also to upgrade their 2024 guidance again. So, they now trade almost at 400 euros. Their earnings per share in the last quarter were €2.29 versus 184 the quarter last year. It's a 24% increase. In this, their margins are flat, around 30%. So this company is just doing really, really well, Ferrari. And it's always the question: is this a dividend stock, a dividend growth stock, or is the growth stock? Well, it's a growth stock that pays a growing dividend. Let's call it like that. Really, really impressed. Again, they won the Le Mans, 24 hours of Le Mans. I was there. I wished Kubica would have won with the yellow Ferrari that day, but they screwed up a little bit. And it's quite interesting that they won Le Mans, because I think last year they won straight away after an absence of maybe 20 years. I don't know exactly how long. And now they won again. So they are able to go away for a few decades, let's say, and come back and straight away win with those hyper performance cars. It just shows you the strength of the brand, the strength of the engineering. Well, they are struggling a bit in Formula One, but other than that, I mean, very, very good company.
Yeah, it's crazy that the company's financials are so much linked into motorsports, Le Mans and Formula One.
Yeah.
And when we start to see Ferrari, because Ferrari were doing well at the start of last year, and that was reflecting in what we saw their financials, and obviously Le Mans over the last 2 years as well. I watched a good film actually. We were delayed on a plane this week. Ford versus Ferrari. It's all about Le Mans.
Yeah, I saw it.
It's quite good. Quite good watch. But such an iconic company, everybody loves. I mean, tell me a child from Europe or even America that does not dream of owning a red Ferrari. I mean, it's
the first toy car that you get as a child. Usually,
yeah,
you don't get a Ford, Ford Escort or what Ford Focus.
Ford Focus, yeah. So I think if you, I mean, I'd love to own Ferrari. You don't even buy the company, do you? You buy the story. You buy the That's what you're buying. I'm buying the story, and the top quality. Proud that they're European, and Italians are very proud of them as well. So I would not blame them. Let's move on. We got two more, and Unilever is on our list. And look, we had to talk about Unilever. They've been dead money for the past 4 to 5 years. I sold them. I ran out of patience. We spoke about patience with Intel. I ran out of patience with Unilever. I think if we flick back 3-4 months ago, when they released our new strategy, we kind of came out. The CEO spoke. Heinz Schumacher, is it Heinz?
Heinz Schumacher.
Yeah, Heinz Schumacher. He spoke quite well. They have this growth strategy that they're pursuing, and he made all the right noises. But as I said, my patience ran out. Well, when you fast forward into this quarter, it seems like that he's starting to act on some of those promises. One of the things that he was talking about and talked about quite a bit were these power brands, and getting them back to growth, and not through pricing, through volume. And he was very specific on that. He wants to get them back to growth. Because these power brands make up of 75% of all turnover. So it's quite important that you're not just relying on price. Well, sales volumes in these were up 4%, which is pretty much on guidance with what he was anticipating. So we talk about Pat Gelsinger, where he made a lot of the right noises, but we didn't see any of the actions come out. I think Hein has come in, and within the first 3 to 4 months after he's made this strategy, we're starting to see some of these actions come into play. He spoke about the ice cream business and getting rid of that. I think they have the legal entity set up there now. They're getting the operating model in place, and they just need to sort out the financials. So he'll probably have that separation by next year. It looks like. But look, it's so good to see. We look at the sales growth. We look at beauty and well-being up 7%, personal care up 5.6%, home care up 3%, and this is on top of what we're seeing in terms of a weak consumer. they're actually doing quite well in this period. So it's quite refreshing to see. Earnings per share is 162, up 16%. And most importantly for us dividend investors, we spoke about it earlier, they've returned to dividend growth, which is nice after 3 or 4 years of flat dividends. So look,
Yeah, they found cost savings by firing 3,500 employees, so they could
yeah.
increase the dividends. So we know who's paying for the dividends.
Well, how they wrap that up is they wrap that up as cultural change and productivity step up. And that's what they do. That's what they call it.
Ah.
And they mentioned that they've started employee consultation process in Europe, other markets to follow. So yeah, look, he's just trimming the the fat off the bones. He's getting rid of, because obviously it wasn't needed. There was way too much employees there for what we're doing. He's cut the employees by 3,500 and still seeing this growth. So I get a good feeling about this CEO. I have to say it's still too early. Look, one swallow doesn't make a summer, but I do like the fact that he's come in. He gave us a plan and he seems to be sticking to it. I still find the plan a bit wishy-washy in terms of he's saying he's going to focus on power brands. I don't understand the mechanics of how he's doing it.
Yeah.
But when I see the growth behind it, the sales growth and the volume growth,
Yeah, and the
I'm happy.
margins are getting better indeed. And you mentioned the ice cream business sale. It is just having 0.6%
It's not
in
even.
sales growth. Yeah, while all the rest is up at least 3%. This one's clearly lagging.
Yeah.
So maybe he's making the right call there. And I think we're all tired of seeing smaller magnums in the package. Yeah.
Yeah. I think they're at the point where the ice cream business is just there and they're
Yeah.
just managing it out the door. But I think beauty and well-being and personal care, for me, they're the two big ones. And
Yeah. I think about the stress relief when you sell Ben and Jerry's. You don't need to have any conversation about Israel anymore with them.
yeah, 100%. So look, I know I've sold them. They're gone out of my portfolio, but Unilever are iconic European company and I want them to do really well. So my fingers are crossed and hopefully we get a second quarter like this
Yeah.
next quarter.
This one I'm holding still. I was one time considering to reduce. Yeah. But actually now when I'm starting to see the actions of the CEO coming in, I think I will just do nothing and practice my patience. Maybe going forward, he's able to get it back on a path of growth.
Yeah. Nice one. We did get a couple of other questions about companies that we weren't going to cover, but one of them was from Joe's Broke Dude. And this is your view on Evolution's latest figures. The share price took quite a hit after earnings.
Yeah, and it's actually simple in my opinion. If you just look pure at the financial data, earnings grew year over year by 3.2%. That's not a lot for a high growth business.
No.
Revenues grew by 15%. It's really simple. They are in expansion mode at the moment, investing for the future. They grew employees from 12,750 last year to 15,400 right now. That's an increase of 21% almost. This is also what I saw at ATN, a Dutch stock in the payment industry. They also had one or two of such bad quarters, got slaughtered in the stock market. They were also heavily investing in developers, and now the company is back on track again. So, Evolution, it's just let them do what they need to do to grow the business. There are more and more countries and states in America that are approving digital gambling, online gambling and such. So it's getting there. Their cash flow has been growing with 34% quarter over quarter and 9.4% if you zoom out to the half year numbers. So I have no reason to believe that something changed fundamentally. It's a very strong business, in my opinion. It's, of course, in an industry that many people wouldn't want to be in, like tobacco. like the British BA Systems of this world, the
BAE, yeah.
manufacturers, yeah. So, but in my opinion, it's like if you believe in the long-term vision of the CEO and how it's doing, then this may be an opportunity. Of course, what I would like to say is like there's still quite significant risk involved with this. It's not just regulatory only, but also there's often coming some reports out about how shady it is in Asia, for instance, in China, and what's Evolution's stake in this and such. So I think really it is a company where you're required to do a little bit more due diligence than maybe with an Unilever that we just discussed.
Yeah, definitely risks there. And the more I read about them, the more the risks are apparent in terms of that. But I mean, it's funny we talk about a bad quarter when we're talking about 15.3% revenue growth, and 3% earnings growth because they are investing that money in building their infrastructure. So it's for me, I've no concerns. America is obviously the big one for me. If they break into America and America starts allowing online gambling, I think that's when we'll start to see that expansion. And I think Europe and Asia, I wouldn't say are maxed out, but I don't see a whole lot more room in those areas. So America, I'm bet my money on America. And as I said, I'm going to Vegas next week. I've heard it's expensive. I will let you know when I'm back how expensive it is. But maybe if it is as bad as what I'm reading, people will prefer to stay at home and gamble online. So maybe there's more growth there. Giuseppe has asked about your take on LVMH. I'm asking you because you know this company a little bit better.
Well, LVMH had a difficult quarter. Really simple. Wines and spirits, 12% decline. Let's say for the first half year, I believe, compared to the last year. Fashion, leathers, and goods, which is by far the biggest business, is also 400 million lower, -2%. Watches and jewelry, -5%, and perfume and cosmetics are a bit up, and selective retailing. They're just struggling. Well, not struggling. They are just feeling the consumer weakness. LVMH, specifically in APAC. Other than that, it's just a good company doing well. But it is another example of where a company is sensitive to cycles and consumer spending, which people that just started investing since COVID are not used to. Yeah, because in COVID there was a lot of money printing, which kept us as consumers rich. We saved a lot of money so we could spend a lot on these kinds of things at that moment in time. So I guess there's a whole generation that has for 10 years not experienced weaker consumers, and that's what we're experiencing now. So it's a new reality, and that means that those growth stocks that people would feel like they will go into the stratosphere may also have 1 or 2 bad years. And I think this is what we may see the start of. Who knows? But yeah, that's the reality.
And for a company like LVMH, hopefully it presents some buying opportunities because it's
exactly.
If there's no bad news, stock price will never come down. So we need to have some bad news every now and again.
Exactly.
So we'll move on to some of the other listeners' questions, and we will start with Centrino. And he mentioned this one to you, okay? And he says, "Is the book Die with Zero?" Centrino hasn't read this. Is this book not counterintuitive compared to the idea that in order to reach financial independence, one must maximize his savings rate during his whole life?
That's no, it's not counterintuitive, because to reach FI and what we're doing with Dividend Growth Investor, it's not like I said, maximize savings throughout the whole life at all cost. Yeah, no, that's not true. For instance, I'm now at in the 60% somewhere of cost. I said cost coverage, and I've been doing this while going on vacations and everything. Yeah, continuously. So this book is really focused on experiences. It was Ron Pizur actually recommended this kind of by mentioning that he was reading it. So I picked it up. It's really nice, the book. It effectively says, like, when are your golden, no, in what decade, let's say, of your life you should prioritize what and what kind of experiences, thinking like, okay, when you're younger you're more active, so it's okay to go a little bit more in depth if needed, or to take this I said to not save so that you can go, I don't know, make this dream trip, I don't know, backpacking across the world, because that's what will pay your experience dividends later on. So for me, it was a nice book. It made me reflect on a few things. I think I'm generally doing well with this, but what I also like by this, like, okay, and I'm not there yet. I'm like on 2/3 approximately. Like, okay, but yeah, how do I look at it? For instance, it also talks about like, when is it best to, no, do you need, because for instance, would you like to leave some money for your children when you die?
Yeah,
Yeah,
100%. Yeah,
yeah, but why? Why when you die? Why not? Why not give it all away before you die?
because I need to live off it as well. I need to live. So
Yeah, so
whatever.
that's what this book discusses about.
Mm.
That's what this book is talking about. These arguments that you're using, the guy actually says like, well, they kind of make no sense. So for instance, it talks about people, and actually put a poll on Twitter as well with this, and people reflecting on this. And there was one story also from one person there. But generally speaking, like, maybe the milestone that where your kids will need the money the most is in their 20s if they want to buy a house. Maybe you can already give some of their inheritance for the future already to support them at those milestones in life, and then they just know they will get nothing when you die, because you will be doing the math like that you're on zero by the time you die.
Yeah.
So that's kind of what this book is doing to your mind. It's kind of a big mind fuck, maybe to Centrino's comment. But, I like to read it. I think any book about wealth, there are some takeaways from. And here's, for instance, a takeaway like, okay, am I having the right priorities in life when it comes to experiences? I might say sometimes saying like, let's do it then, and asking myself the question, why not now? And that's what I like about a book that is thought provoking.
Yeah. Yeah, that makes sense. I suppose the question you asked me was the direct question, but if my kids need the money, no matter what age, I would give them the money if I have it. The thoughts around when I die, they'll just get whatever's left over.
Yeah, and the whole idea is that nothing is left over, because for instance, you could have given the money earlier when they needed it. Yeah, because there's often a worry that, but then I will die in poverty. Well, he even refers to it like, okay, if you're 80 and then have no money anymore, come on, you live the other 80s until you're 80, really nice, but you can protect yourself from that happening as well. And he talks a little bit about how you can do something with life insurance or something like that, so that you have made that. With us, it will be dividend portfolios, but do you need your entire dividend portfolio or not? Can you think about differently? These are all kinds of stuff that are being touched on in the book.
Yeah, nice. Fire Engineer has said, you seem to know quite a bit about Swedish companies for two non-Swedes. Have you ever thought about visiting Sweden, or have you already done that?
I've not been in Sweden yet. I would love to. I would love to make a drive from Warsaw via the Baltic states all the way north, and then take the boat, I guess, not via Russia anymore, but take the boat to Sweden, and then back via also Finland, Sweden, what is it, Norway, and then come back via Netherlands or Denmark again, like via ferry.
Yeah, it'd be fantastic.
It's a dream trip for me, a road trip like that.
We've already told Alan we will visit Sweden.
Yes.
It's definitely on our list. I've heard it's a nice country, so I'm mad to see them. So it's on the list. I don't know when, but it is on the list. Wolf, what percentage of your portfolio is in general investment accounts versus pension accounts?
I don't track my pension accounts really. I would guess up to 10% maybe. So I'm not talking about what I will later get from the government. I'm talking about my employer employer contribution and the tax benefit, the eDGI accounts you can have in Poland, which we leverage for my wife. So maybe 10%. I'm not so much into using that, not because of the tax benefits that I clearly see, but I'm in my low 40s and I'm not going to wait until 60 with living off my dividends. So that's why I'm taking a hit on the tax optimization, let's say now, but it benefits me on the short term.
Yeah. Yeah.
And I
No,
know you can also take still money out of eDGI and such, but call it laziness or something like that. Sometimes it's like on the math, it sounds more wise to do that, but from an effort point of view, I prefer like how I have it now.
these type of questions can get quite heated in Ireland, particularly when you talk about tax, and it's quite
Yeah.
funny. But at the moment, in terms of value, what I'm putting into my pension versus what I invest, it's around 25% of what I invest monthly as well. So that includes obviously what I contribute, and then what I contribute, the company contributes double that as well. So it encompasses all that. As like you, I'm not counting on that. I actually don't even count that in any of my FIRE calculations. It's there, and whatever I have at the end, it's a bonus. I'll see that as a bonus. But roughly around 25%. Akira has asked us, the stock rotation season seems to have kicked off. Should dividend growth investors seize this opportunity, or if not, would you ignore it? That it would ignoring it be your best strategy?
It's really hard to seize the opportunity, right? Because I just depend on my salary that I'm getting in again each month. So in the end, I'm dollar cost averaging. But it's not like that I can now, I don't know, take aside 5 times more money this month and just deploy it into the market. Then I would need to sell my portfolio and do the same kind of rotation, which I'm not doing. It's not my strategy to time the market. So yeah, I don't have a war chest. I had that in the early days a little bit, but not anymore because the cash was just sitting idle. So I'm deploying it. Yeah, so there's nothing to seize for me. I just buy whatever is there that month for the money that I have available, and that's as simple as it gets. How about you?
Yeah, well, if you think of what we do, what I do anyway, was I deposit money from my salary every month into my broker and buy stocks. So like you, I've been seizing the opportunity every month.
Yeah,
Whatever I find
exactly,
is
exactly.
undervalued, I'll buy that. But I get the sentiment behind it. But I think the rotation is into some of these dividend growth stocks, which generally raises their price. Seizing the opportunity in them would have been 6-9 months ago when the price
Yes,
is not there.
exactly,
So,
exactly. The
and
insurance stocks last year.
yeah,
Yeah.
exactly. Tobacco stocks could argue over the last 3 years.
Yes.
So there's always opportunities, and what I try to do is to seize the best opportunity on the end of the month when I'm investing.
Yeah, exactly.
Dividend Gardener has mentioned that it is difficult to pick stocks in Asia. Do you think investment trusts are a good way to get Asian dividend growth exposure? For instance, there's Aberdeen Asia Income Trust or Fidelity China. I think so, Dividend Gardener, and the reason for that is the economics and the mechanics and how investors or businesses think in Asia is generally different than it is in the West. It is a communist country. There's different barriers to entry, particularly if you're buying on local exchanges and trying to get to know the companies there. What you get with an income trust is you get a fund manager, and usually they will be specialized. If it is Aberdeen Asia, they will be specialized in that area. I listen to Money Matters. It's an income trust podcast. There was one a number of weeks ago, and I cannot remember off the top of my head, but there was a guy who was investing in, I'm going to say Hong Kong or one of the smaller niche Asia countries, and he was going through the mechanics and how difficult it is, and for foreign investments, and how he has to navigate that. But I think that's what you get with an income trust. You get a fund manager that will know a hell of a lot more than what you will know unless you're quite competent in that area. So I think if you want to get into Asia, I think income trusts are a great way to start.
Or you just buy Unilever, Nike, Starbucks,
Yeah,
who all have a large exposure, LVMH. Yeah,
yeah. By multinational global companies.
exactly.
works the same. Josh has asked us to say, I'll imagine you'll be talking about attractive dividend stocks on recent dips, but he's curious. What about any Japanese dividend stocks you're interested in, considering their larger dip? Yeah, I think Japan had a really big crash again, hasn't it?
I'm not looking at all at Japan, and he mentioned it also. Maybe none, as you're US Euro focused, and yeah, that's it, Josh. I don't look at Japan. It's called ignorance, but also time. It's simply a time constraint that I have.
Yeah.
So I don't need to own them. It's the joy of missing out.
A couple of companies I like is Nintendo and
of course, Sentiment.
Yeah, Sentiment and Keyence as well. Keyence is a quality company, do quality products. They would be the two I would be interested in if I was investing in Japan. But honestly, I have no interest in going that far over. I'll stick to Europe and US. And then we'll finish off with Alexandros, and he's asked us which tobacco stock is your favorite. I like British American Tobacco. I think they are globally more diversified. They've had some good news with their non-standard products as well. But what was quite interesting is that I spent the last week in Italy with work. Our machine builders based over there. Quite a big machine builder, and they also have a tobacco segment. And just chatting with some of the guys, I was asking them like who they make the most machines for. Do we see an uptick in orders? And what I was told was that Philip Morris is doing quite well, and they are ordering a shit ton of machines. I think the orders are after coming in heavy this year compared to every other year. So it took me by surprise. Philip Morris obviously is a good company as well. I've never dug deep enough into them as I have with Altria and British American Tobacco, but the conversations I had over there piqued my interest in them, I have to say.
Nice. Hey, well, this was the last question. Thank you so much, everyone, for your questions again. And well, Derek, earnings season. I mean, I really love these shows about earnings season because it's our favorite holdings here that we can discuss and see how they are doing. Most often well, sometimes not so well. But generally speaking, I'm really, really happy again with how it's going. And I can't wait for next week and the weeks after to see what's more coming. So yeah, thanks so much.
God bless earnings season. And thanks to all our listeners. Hope you enjoyed the break from us. And we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.